Privilege to come and moderate this panel for you guys today. We are fortunate to have a highly distinguished panel with us to discuss Professor Bruckner's work. So we'll begin with introducing the panel, and then after they speak, we'll open it up to some questions for Q&A, and then we'll conclude with closing remarks from the journal. So to start, we have Ms. Caroline Bruckner. She is a tax professor and faculty at American University Kogod School of Business and is the managing director of the Kogod Tax Policy Center. She has testified multiple times before both the United States House of Representatives and Senate congressional committees, as well as the IRS. Since 2015, she has released groundbreaking research on the gig economy, as well as the women's business owners and the U.S. tax code. She teaches courses in business law, fundamental principles of federal income tax, and business implications of the future of work. Prior to joining American University in 2015, she worked for the U.S. Senate Committee on Small Business and Entrepreneurship, or as SBC as it calls it, from 2009 to 2014. Ultimately, as chief counsel, where she developed small business tax legislation and advised the committee and its chair on tax, labor, and budget matters. Prior to the public service, Ms. Bruckner was a senior associate at PricewaterhouseCoopers, working with the Washington National Tax Services. She's also served as an associate employee benefits group at Paul Hastings LLP. Bruckner has a master's in taxation, or an LLM, from Georgetown University Law Center, as well as a Juris Doctorate from George Mason University. We also have Professor Leandra Letterman, who is a professor here at Indiana University Maurer School of Law. She is a William W. Oliver Professor of Tax Law and Director of the Tax Program at Indiana University. She has been published in over 50 articles and co-authors of a book on tax procedure and a book of corporate taxation. She has Fulbright research grant at the University of Luxembourg in the spring of 2019. She's also a member of the ALI and Fellowship of American College of Tax Counsel. She has been a law professor at IU Maurer for over 26 years, or she's been a professor of law for over 26 years, including 16 at Indiana University. We also have with us Professor Denville Duncan. Duncan is an economist whose primary research focuses on the causes and consequences of tax evasion. His research has focused on the impact of tax evasion opportunities on income inequality, labor supply, risk-taking behavior, and tax incidents. He's also been published in top journals such as European Economic Review, the Journal of Economics and Behavior and Organization, the National Tax Journal, and International Tax and Public Finance. He is currently with the O'Neill faculty since 2010. So we'll begin with Professor Bruckner presenting her work, and followed by Professor Letterman and Professor Duncan presenting their topics as well. Following, we'll have some Q&A for you guys, and we'll have a conclusion.
Thank you so much. Hi. I'm so excited to be here, and thank you so much for hanging on for the very last panel. I very much appreciate you being here because I love talking about this stuff, and I can talk about it all day, and I promise, despite the overly long title, to not make it boring, even though it's also about tax. This paper is designed very specifically as a policy paper with data dressing. And before we go through the specifics of the paper, I need to absolutely confess that I am not an economist by any stretch of the imagination. I'm a tax lawyer. However, in putting these estimates together, I partnered with a guy named Tom Hungerford, who is an economist, and he also happens to be the former Assistant Commissioner for Retirement Policy for the Social Security Administration. And that's helpful because the taxes that we're talking about are Social Security taxes, and looking at how gig economy work and the failure to report important tax information by the platforms impacts drivers, hosts, so in some cases hosts, not always, but gig economy platform workers and more generally independent contractors, how that impacts their ability to pay into their Social Security and their otherwise retirement security going forward. So this is the agenda. We're going to stick to this agenda, and we have a very short time frame because I hate being the one person standing between you all and happy hour or reception. So I'm going to try to go really quickly through all of this information and get through this agenda very quickly, and I'm going to try to only spend 20 minutes because while this stuff is really important, I really want to hear what these two have to say because I have not had a chance to have constructive feedback from lawyers. I have had feedback on this paper from economists at Census and some other folks, but I'm really excited to hear about the feedback for this paper, which I'm very intent on revising and hopefully will have it published soon. I'm just thrilled to be here. So this paper puts together an estimate of the amount of Social Security contributions or tax leakage that is occurring as part of and in connection with the rise of the on-demand platform economy. And in order to try to measure that, you've got to have a data set. And when I first began picking around to try to find a good data set to generate estimates. And why do I need estimates? I need estimates because I'm, in my former life, a senior policy advisor. And in order to get Congress to pay attention to something that is in need of a legislative remedy, you have to constructively approach them with data. And when I was organizing how I would convey to Congress that the information reporting system that's in place for gig economy workers and on-platform workers in particular is wildly inefficient and allows for an excess of tax leakage that no one contemplated when those rules were put into place in 2008. I knew I needed to get a good data source that could measure multiple streams of income because most folks, and a lot of folks rather, that do on-demand platform work, both on-platform and off-platform, use multiple streams of income to generate income to live on. And in poking around, I stumbled upon Census's survey of income, redesigned survey of income and program participation. And it's a survey that is a pretty big survey. And the reason that I chose this particular survey is that it allows us to look at multiple payment streams that survey participants have. It's a fairly large survey that's done over a multi-year process. The sample size of the panels for the survey can range from 14,000 to over 37,000. So in terms of general data sets, it's a pretty good one. But like with every data set, there are certain limitations into how you should interpret this specific survey data because it doesn't specifically ask, did you earn money from working with a platform, right? So you kind of have to approximate the categories of industry in addition to the amount of collective earnings that you're extrapolating from the census survey data. Again, I'm not an economist, but I did work with several economists at SIP who, in addition to a contributor who is an expert and certified expert in SIP to put together the variables that we use to streamline the data from the 2014 SIP data. Which, by the way, keep in mind, this data is also from 2014, so it's not even a perfect data set that reflects current usage or current activity that we see with gig economy workers. But this is the primary data set that I use to construct these estimates. However, in an overabundance of caution, I designed the paper to include a comparative analysis approach, and I used lots of different data sets with different methodologies to illustrate just how big the on-platform economy is and how much tax leakage there is in the on-platform economy. But before we get there, really quickly, let me go over some basic definitions that will help you understand the different types of workers that we're talking about and their earnings that we're talking about when we talk about gig economy work, on-platform work, off-platform work, and independent contractor work. Because when you're trying to measure the total population of people that are doing this kind of work, it's always important to establish baseline definitional standards because everyone has a different kind of way of measuring this kind of work using different definitions. And in order to, this is a main driver as to why I always recommend that anyone doing this kind of work, anyone trying to do any kind of measurement work, use a comparative analysis approach of different data sets to try to really get a complete picture of the different kinds of people that are doing this kind of work. So how do we define these kind of workers? Well, generally you have gig economy workers, which are workers that are working in the on-demand economy, and that means that they do work as needed by customers and for clients. We can break on-demand gig economy work down into two separate subsets. Folks that actually use platforms to connect with their customers and have those platforms process payment, which for tax purposes is an incredibly important distinguishing factor that is incredibly relevant for tax administration purposes. And then you have general off-platform work, which is work that has always existed in our economy. It is the neighborhood kid that comes over and mows your lawn or babysits your kid. That work has always existed. What is different is the advent of on-platform work, which has formalized the ability for independent contractors to connect with, that are service providers and sellers, to connect with their customer base. The on-platform folks that I refer to and workers that I refer to are specifically limited to those that work for platforms that process payment. And then you have just a generalized group of independent contractors who are self-employed, non-traditional workers working outside of traditional employment relationships. So when we try to get a handle on how many of these workers that are out there, there are some basic data sets that everyone that does gig economy data analysis kind of looks to first. And the first one of those is the Alternative Contingent Worker Survey, which was done by the Bureau of Labor Standards in 2017, and the results were released in 2018. This is essentially a timestamp on a survey that was done originally in 2005. So they redid the exact same survey in 2017. And the results of that survey showed that independent contract work had not grown at all in the intervening years between 2005 and 2017. And one of the reasons that there was no exponential growth for this kind of work is that the question that they asked workers was, do you do independent contract work as your sole source of income? And what we know about gig economy on-platform workers is that the majority of those folks do it as a supplemental source of income on the side apart from their full-time job. Now, in order to try to capture a complete picture of who is doing on-platform work, BLS also included an additional 4 questions targeted specifically to survey participants asking, did you work for a platform? Did you earn income doing platform work? But even BLS, when they announced the results in 2018, came clean and said the questions did not work as intended. And actually, they would not repeat those survey questions again. And as you'll see here, they found that in that 1 month period that they measured, that there was only 1.6 million people doing on-platform work. This contrasts significantly with a major study that has been produced by the J.P. Morgan Chase Institute, which is a separate think tank that's been funded and housed inside of J.P. Morgan Chase, which it is a think tank that actually uses J.P. Morgan Chase account holder data in an anonymized way to produce all sorts of different data points that is then used for a whole host of public policy purposes. They claim it's for information for the public good. What's really important to know about the J.P. Morgan Chase Institute data is that it reflects actual payments by platforms that process payments into account holders' bank accounts. To me, that is real-time, absolute, verifiable information on how many people, and in a verifiable way that you can count how many people are actually working in the overall on-platform economy. And they find with their data that in any given month that there's about 2.3 million people doing some sort of on-platform work. And we'll talk a little bit more about the specifics of that data in just a couple of slides. The data set that I use, the SIP data set that I used, which I controlled for a whole bunch of variables, and that's in a slide later in the presentation, found that in general, there was 7.1 million people in 2014 that were doing self-employed, non-employment, non-traditional employment work that could be characterized as independent contractors. And then in the on-demand workers category, because of constraints of the definitions used in the survey and the questions that were asked, I ultimately had to narrow the variables down to including both on-platform and off-platform workers that were doing jobs that were occurring in the on-demand economy. And then lastly, earlier in 2019, Treasury's Inspector General put out a major tax administration report that looked at tax return data to determine how many people had been working in the on-platform work, and they concluded that from 2012 to 2016, there were a total of 3.8 million people that had done on-demand platform work over a 4-year period. There is no way that number is accurate, and there is no way it is correct. And the reason that we know that it is not accurate is because in any given month, in the JP Morgan Chase Institute data, it's 2.3 million, and that number has been consistent since JP Morgan Chase first put out their data set in 2016. The reason that the TIGTA report is so incredibly low is that they relied on tax administration or tax return information in order to aggregate their data. And the reality is the majority of people that are doing work in on-platform work are not getting information returns and therefore might not necessarily be filing tax returns that report their on-platform work. And that has been the source of the estimates that we're going to talk about later, throughout this presentation. Now, really quickly, I wasn't here earlier this morning. I was catching a flight from DC, so I hope this is not review for anyone. But the way that I like to think about the gig economy and how I present it in my work is consistent with the basic definitions that are used by the JP Morgan Chase Institute, because it includes primarily transportation, which is your Uber drivers and your Lyfts, your Lyft drivers, ride sharing. Then you have selling. You got to have your Etsy and your eBay folks. Then you have other non-transport work, which is your caregivers, your dog walkers, your errand runners, and what have you. And then this last section is leasing. This category of on-platform work has different tax filing obligations than regular labor platforms, which would be more traditionally the non-transport work and the transportation work. But what you'll see when you look at the monthly averages that JP Morgan Chase Institute has managed to calculate using their incredibly broad data set is that transportation, while the biggest sector of on-platform work, is paid at just about $783, and that's not net. That's just payments from the platforms into accounts, and followed by other services and then selling. But the top, highest income producing sector of on-platform work is leasing. This is your Airbnbs, your One Fine Stay, and what have you. Contrast that with general independent contract work, which is independent contractors that are doing that kind of work full-time, not necessarily on-platform work, but just general private sector data from on-platform work. And you'll see that the average income from full-time workers, and this is annualized income, is much higher than what these monthly average incomes would be if you were to annualize them. But an important note when you're talking about on-platform work in terms of income and hours, the people that do this kind of work the majority of people that do this kind of work do it as a supplemental source of income. And they do it for, on average, I found in one of my own surveys, less than 20 hours a week. The JP Morgan Chase found that there is a small, consistent contingency of labor platform workers that do that work, and that contingency is that do the work full time, and that contingency is between 25 and 30%. But that the majority of individuals in the on-demand platform economy work about 12 hours a week doing this. However, in the months that they do this kind of work, it is an important up to 20% source of supplemental income for those folks. In addition, the thing to remember about these workers and why I can't annualize the number that there are about 2.3 million people in any given month doing this kind of work is that it's not the same 2.3 million people every month. There's a high churn, particularly with respect to labor platforms for doing this kind of work. If you were to try to annualize the total number of people that are doing this kind of work, JP Morgan Chase says that you would be looking at more like 5 million households per month. So what are the tax rules that are applicable? And we have to level set to make sure that we're all on the same page, that we're talking about the tax rules that are applicable, that are foundational for understanding the estimates that I'm about to show you and how much tax leakage there is when you're talking about the gig economy workers, both on platform and off platform, using the SIP data. Well, in general, This shows you that there are a whole bunch of questions, and the last panel did an exceptional job talking about the labor and employment implications that arise in connection with on-demand platform work, which we are setting those very important concerns aside for purposes of this conversation. But we're talking more about assuming that on-demand platform workers and off-platform workers are independent contractors. Their tax obligations are entirely different than the tax obligations that you have from traditional employment work. Specifically, once you have, like, for example, with self-employment tax, which is the tax that's used to collect Social Security and Medicare taxes by independent contractors. So any taxpayer with net earnings of $400 is required to pay self-employment tax, which is the Social Security and Medicare taxes that are due on that income, and file a schedule, what's called a Schedule SE, together with their Form 1040. And in addition, there are other important tax obligations that apply specifically to this category of workers that can trip up these workers when they go to file their taxes. And that would be in the range of quarterly estimated payments. Once a taxpayer is expected to owe more than $1,000 in taxes for a given year, they're required to make what's called quarterly estimated payments on April 15th, June 15th, September 15th, and January 15th. And usually it's not income taxes owed that trip people over that $1,000 threshold. It's usually these self-employment taxes, which is 15.3% on earnings of $400 over $400. And those are the two primary tax rules that we're going to talk about for purposes of the rest of this conversation. Now, trends in gig economy platform work. I included this slide because why should you care? You should care about on-platform work even though it's relatively small because it's growing really fast. And it is anything that is growing that fast. It's grown fivefold in 4 years from about 3% of families in 2013 to about 1.6 in 2017. Anything that's growing that fast and that has an adoption rate that much is something worth paying attention to. Think about how it personally impacts you in your lives. Two of my best friends graduated from Georgetown Law School. One is a lawyer at the Federal Trade Commission. The other one runs the Human Rights Project at the ABA. They do Rover.com. My husband's cousin is a CEO of a startup company out in San Francisco, and she rents out Airbnb of her basement and made $40,000 last year doing Airbnb. The woman who was sitting right here in the last panel, her colleague at UC Hastings, the only way he can afford his rent in San Francisco is because he does Airbnb. These are people who traditionally would not have necessarily had side hustles outside of traditional academic side hustles, I suspect, like consulting or what have you, but they too are engaging. It's not just low-wage ride-sharing work, but it is a whole range of low-wage and high-wage folks who are engaging in this kind of work. It is growing that fast, and it is almost ubiquitous in how it's come to impact us in our everyday lives. Why does this matter from a tax perspective, and how does this get us to the estimates that we really want to talk about today? Well, just to give you a little bit of background, when you work for a platform doing on-platform work and that platform processes payment for you, the tax information reporting forms that are used are called 1099-K forms. And those are for reporting electronic payments. And the trick here is that the platforms are not required to send the IRS or drivers a 1099-K or even Airbnb hosts. It is not limited just to the labor platforms. It's also the selling platforms and the home sharing platforms until there has been $20,000 in payments and 200 transactions. Now, if you refer back to the earlier slide I showed you with the monthly incomes of how much folks are making in the gig economy, this is the majority of folks. These are the averages of monthly income of what they're earning doing gig economy work. And remember, I already told you how they cycle in and out of this, and there's a high churn. It is very rare that anyone in doing this kind of work for less than full time is going to reach the $20,000 threshold, much less the $200,000 threshold. For example, my cousin in San Francisco made $40,000 last year and did not get a 1099-K from Airbnb. She filed every single, she absolutely reported all of her income because she aggressively took every single expense that she could. She wrote off her cable, and claimed it was part of the Airbnb. But that is the reality of having such a high threshold for reporting for these kinds of payments. And the platforms And the platforms absolutely take advantage of the current tax rules to not file 1099-Ks or give them to the drivers. Now, how do we get to where we are? Well, really quickly, the 1099-K rules are based in Internal Revenue Code Section 6050 Cap W, which was put into the tax code in 2008. Congress was very worried that there was a ton of underreporting that was going on by independent contractors, and at the time in 2008, they were really worried about bloggers being millionaires. And that was primarily what they were talking about when they created the information reporting rules that apply to these platforms. In addition, at the time, the biggest player in the platform space was eBay. And eBay at the time, when you talk to folks at eBay, they'll tell you that their entire business model is such that 80% of the folks that sell on eBay, it's like an online garage sale. You're just selling used stuff. There's no tax consequence there because chances are you're selling something that you bought for much more than what you paid, or you're selling it for much less than what you paid for it, right? So there's no tax consequence there. And so eBay fought very, very hard in 2008 to ensure that the information reporting rules were as generous as possible for their online sellers, which is how we got to a $20,000 threshold. In addition, that is also how they fought so very hard to have the transaction requirement be 200 transactions and $20,000 in revenue. And that specific safe harbor doesn't apply to everyone that processes electronic payment, but it is specific to third-party settlement organizations, which are organizations that process electronic payment on behalf of payees and that are not merchant acquiring banks. At the onset of the gig economy, when it got to be really big in 2014, 2015, all of the platforms were confused about what their tax filing obligations were with respect to their service providers and sellers. And originally, both Lyft and Uber did provide 1099s to their drivers using the traditional form that's used for non-employee compensation, which is called a 1099 miscellaneous, and that's when there's payments of $600 or more for non-employee compensation. All of the platforms got together and decided that this would be the traditional amount that the traditional filing threshold that they should use for filing 1099-Ks or 1099 miscellaneous for all of their service providers and sellers. Since it has come to light that there is this massive reporting threshold, discrepancy between the $600 threshold and the $20,200 transaction threshold, each of the major platforms has reverted to only providing 1099s to their service providers and sellers when and if there is $20,000 of transactions and $20,000 in payments and 200 transactions. This is completely legal, and they went and got private letter rulings for IRS to sustain their tax filing positions in this regard. Why is that a problem? It is a huge problem because if you don't get a tax form, that means that the IRS doesn't either. And so just to try to take the temperature on how big a problem this is, in 2015, I did a survey of the National Association of the Self-Employed, which is a trade association that exists in Washington, D.C. I had never done a survey before, but the guy that I worked with is a guy named Jim White, who is head of strategic tax issues for GAO and had done dozens and dozens of surveys. And he and I got together, put together the questions, gave them over to the National Association of the Self-Employed to see if this biased population of folks who shouldn't know what their self-employment tax filing obligations are by virtue of the fact of their membership in the National Association of the Self-Employed knew what their tax filing responsibilities and obligations were. As you can see from this slide, our survey results were dismal to say the least. 36% did not understand what kind of records they needed to keep. 43% were unaware as to how much they would owe in taxes and didn't set aside any kind of money to pay their taxes. 47% didn't know about any tax deductions, expenses, or credits that could be claimed with respect to their on-demand platform income. But most importantly, for the first time, we were able to quantify exactly how many people in this small survey, which is not nationally representative and doesn't even intend to be. It is a biased survey by definition, but 68% of the people I surveyed that did on-platform work did not get any kind of 1099-K or 1099 miscellaneous, which means that the IRS did not either. This was a huge tipping point that sparked the current paper that I'm here to talk about today, because this made me realize exactly how much tax leakage, not exactly, but it made me recognize how much tax leakage could possibly be going on, because none of these workers in this fastest growing sector of our labor economy, albeit small but fast growing, weren't getting any kind of information reporting returns for the income that they were doing on their on-platform work. Now, I put together a series of estimates to try to quantify this problem for policymakers. These are no better than back-of-the-envelope estimates, and they're designed with a specific methodology to highlight just how big the problem could be. And there are limitations and caveats that are extensively footnoted within the paper for each of these individual estimates. So, for example, when we look at the amount of SE tax that's not being paid in the Treasury Inspector General report for 2019, that doesn't include, that only reflects people that actually got a 1099-K, which is not the majority of people that are actually earning income in the on-demand platform economy. With respect to the JP Morgan Chase Institute data, that actually includes home sharing and leasing of assets, which in certain circumstances, you file a different schedule, and self-employment taxes do not attach to that kind of income and aren't required for that kind of income. So that could be an overstatement. But with respect to the gig economy, with respect to the alternative contingent worker survey, we also have fairly limited numbers in terms of the caveats that I already discussed earlier with respect to the alternative contingent worker survey. With respect to the SIP data in particular, however, using the variables that we had for 2014, I was able to quantify that for on-demand workers, and this included an overly broad definition of on-demand workers, but probably a very conservative estimate of their collective earnings using that data, there's about $2.3 billion for just that population of workers that did not get reported for Social Security. That's just 1 year in 2014. The way that congressional budgeting works, you normally would take that kind of number for a policy change, and you would multiply it times 10. So maybe $2.3 million isn't that much, but when you have a legislative change and the Joint Committee on Tax would go in and try to quantify how much that would be over a 10-year period, it becomes a much bigger number much more quickly. These numbers were designed to really spark conversation, and not to be definitive in any way, but to spark conversation as to the tax gap implications of doing this kind of work. And why does this kind of work matter? I'm basically telling you that low-income people aren't paying their taxes. Should we really be penalizing these people for not paying taxes on what little income they earn? That's not the perspective that I have with respect to this, because there are very clear Social Security implications for this. This specifically, how you are credited for your Social Security is all through whether or not you pay and are credited for paying self-employment tax. These workers, the majority of them, do not have traditional retirement or any other retirement strategy other than Social Security. And by not paying into Social Security, they are doing themselves a disservice in that they're not getting credited on the way out as beneficiaries. This also has very important gender dynamics, particularly that's informed by forthcoming research on the implications for women doing gig economy work. Women tend to live longer, they have higher healthcare costs, and they are also subject to the pay gap. They also take time out of the traditional workforce, and so they don't necessarily have the same opportunity to pay into Social Security. And when they do this kind of work and then don't report this kind of income, they're getting a double hit for not being able to shore up their retirement shortfalls. So what we're seeing now, actually, in some data, is that there's an increase of women doing gig economy work to shore up their retirement shortfalls. That research is going to be coming out in the fall. I'm going to cut it off there. I'm happy to answer additional questions and feedback. Sorry I went too long.
Thank you. right. Thank you so much to Abby Stemler and Ben Adams for inviting me to be on this panel and organizing this terrific conference. And also thank you to Doug Stratton for moderating. And thank you, Caroline Bruckner, for that very interesting paper. I'm really glad to have an opportunity to comment on it. There's a large legal literature and also a large economics literature on tax compliance, but there's much less on employment tax compliance. And this paper picks up where other research on the gig economy has left off by focusing on underpayment of self-employment tax. So it's really nice to see a paper that attempts to quantify the amount of noncompliance in this sector. I haven't actually written anything on the gig economy, but it's fascinated me since I first heard Professor Shuyi Wei speak on the tax issues in 2014. And I commented from the tax compliance side because I've done a lot of research into why people do or don't pay taxes. So after I talked with Shuyi about her paper and various things that Uber drivers had told her, every time I would take an Uber or a Lyft, I would sort of interview the driver. So I'd sort of start casually, how long have you been driving? Do you drive both for Uber and for Lyft? Are you setting aside money to pay the taxes? And if they've been driving for long enough, which a lot of them haven't, have they received a 1099? And sometimes I would get a question back like, are you planning to start driving for Uber yourself? Or do you work for the IRS? But somehow I managed to keep my star rating as a passenger enough intact that people will still pick me up if I need an Uber. But of course, these anecdotal stories from Uber drivers really don't give you a representative picture. So it's great to have the results of systematic surveys and data collections like the ones that Professor Bruckner talked to us about. So let me start by making a few general comments. I thought that having the terminology for on-platform and off-platform workers was really helpful, and also on-demand workers and independent contractors. I did find sometimes in the paper that I wasn't completely clear on on-demand workers being a subset of independent contractors. I think that's what you're intending rather than something contrasted with independent contractors. And I think I also misunderstood thinking that off-platform workers in the demand economy were people who like work for Uber but work as an accountant or something, or work as a secretary. And I think what you actually are meaning is on-platform gig workers and off-platform gig workers. I also thought it was interesting that the SIP data seemed to show from what you report in the paper very different demographics for the workers on all measures, age, gender, and race, than the other data. And so I was wondering why that is, and perhaps, and I suspect part of it might be that transportation workers are very different in their demographics than Airbnb hosts. And so that might be part of the issue. All right, let me turn to some more kind of specific comments that I have some slides on. So first question, how large of an impact does self-employment tax underpayment have? And this is the latest tax gap map, which is from September 2019 for the 2011 to 2013 tax years. And I'm sure you can't read all the little numbers, but you can see here at the arrow, the self-employment component of the federal tax gap is $45 billion per year on average for those tax years. And then I've kind of blown up the orange part a little bit. And you can see this is less than non-business income, which is $57 billion, and less than half of business income, which is $110 billion in the square towards the upper left. But $45 billion is still a large figure. It's important. And also gig economy workers who aren't reporting self-employment tax liability are probably also not reporting their gig economy income for income tax purposes. So even though the gig economy workers are not reflective of all of this self-employment tax gap, this is growing, as Professor Bruckner said, and it is important. In addition, it's really important to note that the IRS statistics from this latest tax gap research and with all previous tax gap studies have found that as income visibility decreases, non-compliance increases. So this is an IRS bar graph to which I added the words in red. And so basically what you're seeing is that as there's less information reporting and not withholding, that you see much greater noncompliance. The percentage of noncompliance is much higher in terms of the dollars that are not reported, and the absolute magnitude as well. And lots of that noncompliance involves cash income. So part of what's really interesting about the gig economy from a tax compliance perspective is the workers typically are receiving credit card payments. And if you look at some of the traditional tax compliance literature, like there's a paper by Susie Morse and Joe Bankman that suggests that people tend to treat amounts paid by credit card as more visible. So if you're running a store or your mom and pop store or a restaurant, you might not report all the cash, but you probably report the credit card payments. But the reality is a credit card, that's still not as visible and easy to check for the IRS as where there's third-party information reporting. The IRS would still have to audit in order to know about the credit card payments, whereas with these information reports, like a 1099, they can just do automated return matching. So a lot of research supports the importance of third-party reporting, and in my work, I analogize it to a red light camera. So if you see a sign that basically says the government is watching, you are much less likely to run the red light, even if you would be so inclined otherwise. And that's the same thing when you know that the government knows you got that income. You get a W-2 or a 1099, and you know that the government knows about it. So the advent of the Form 1099-K, which Professor Bruckner mentioned, was really positive compared to having no information reporting at all. And as she mentioned, it was intended for payment card companies and third-party networks like eBay, and it was interesting to see Uber and Lyft sort of vacillating about whether that was the correct form, and should they use that $20,000/200 transaction threshold or the lower reporting threshold of $600 that applies to the 1099 MISC. Now, interestingly, Uber and Lyft have, for all tax years, have used 1099 MISC to report to their drivers income for activities other than driving. So referral bonuses, other bonuses, weekly guarantees, that kind of thing. But they've vacillated in what they use for the income that workers earn from driving. So for example, in 2015, Uber did issue 1099-Ks, but it used the lower $600 threshold. And here's some information from the Lyft website. So it used the $600 threshold in 2016 and 2017, but not 2018, and actually not in 2015. And there's work on this by Shi Wei and Diane Ring that talks about that scraped websites where drivers talk to each other, about the confusion that can cause when they get a 1099 from one platform and not the other that they also drive for, et cetera. Another thing that's really interesting that Professor Bruckner mentioned in the paper is that Massachusetts and Vermont have implemented these special $600 thresholds for information reporting. I was not aware of that before reading the paper, and I suspect that this almost certainly has spillover effects to federal tax reporting. But it would be interesting, because workers probably think if they get a tax form from the state, they probably suspect that the federal government may also find out and that income is more visible, even though they didn't get a form that was reported to the federal government, if they even make that nuanced distinction. But these state-by-state differences and these year-by-year differences also seem like a candidate for really interesting experimental work on the magnitude of the effects of the effects of information reporting. There's been some work already I know Professor Duncan will mention, but I think there could potentially be more. And let me also talk about the magnitude of the problem, and I'll just look at one aspect, the receipt of Social Security benefits down the line. So for one question is, what proportion of gig workers, whether it's crowd workers like those who work for Amazon's Mechanical Turk, or other gig economy workers, do it as their main source of income? And Professor Bruckner mentioned a lot of people don't. They're doing it as a side hustle. They may do it for a few months to maybe fill in when they lost a job before they find another full-time job. So a lot of the workers do have full-time employment at some point during the year, or certainly if you look over a multi-year period, you don't have many people who are doing only gig work full-time for multiple years. So if they have other sources of income, i.e. income from employment, they will have Social Security coverage through their main jobs. They're just, of course, not paying as much into Social Security as they should, and they perhaps won't be then getting as much in benefits as they should, but they probably aren't getting nothing. Another thing that's interesting about this is the effect on women that Professor Bruckner mentioned. So part of it, I would think also, is you have some women who otherwise would have just been doing stay-at-home childcare and perhaps not earning much money on the side, who can now have an eBay store or an Etsy store or rent a room out in their home and supplement their income. So from a non-tax perspective, you could kind of have a positive situation for women. But on the other hand, if you have women who are in the gig economy who aren't paying into Social Security, if in fact they're going to get less benefits and it has a disproportionate impact by gender, we'd be really concerned about that. But one of the things about that is that and I am not an expert on Social Security, but my understanding is that a lot of spouses, particularly wives, their Social Security benefit is often higher when calculated with respect to their husband's benefit. They can get 50% of what their husband gets rather than their own benefit. And that was already true before the gig economy. So you can actually be someone who's never had a job where you paid Social Security and then be married to someone who was a worker in, paying into Social Security and still get a benefit that's 50% of your spouse's benefit. So I think that's something that might be taken into account is, will there really be a burden on women, or will it turn out that their Social Security benefits really aren't hurt that much because of the spousal benefit, assuming the Social Security system stays the same? And then finally, the last slide here is possible solutions to the underreporting that we're seeing. So my thought would be, what about requiring gig worker platforms to use Form 1099 MISC at the $600 threshold for everything? The paper proposes, I think follows another proposal in suggesting making the 1099K and 1099 MISC thresholds identical, but raising them to $1,000. And I wonder why raise it, because that would likely decrease compliance. I realize that the $600 hasn't been adjusted for inflation.
Right. It's for political expediency.
Yeah, I see. Okay. I would think that technology's gotten, over time, it's probably easier to do information reporting, so you could justify keeping the threshold, even though that's de facto lowering it. And then here's a totally different out-of-the-box idea for a possible solution. Why not digital real-time reporting? So a number of countries, with respect to their value-added taxes, use digital real-time reporting where transaction information is sent digitally directly to the tax authority from the cash register or from the credit card payment. And not surprisingly, the empirical work that there is on this shows that this increases tax compliance. So that would be just a completely different way to try to tackle this, using technology essentially to increase transparency and visibility into this income even further. So I'll conclude there. Thank you again for inviting me to participate in this panel. It'll be really interesting to see how tax compliance in the gig sector evolves.
Okay, so I should say thank you also for inviting me. I participate in the gig economy. I rent Airbnb. I use Uber whenever I travel. But that's kind of the extent of it. I also use MTurk for some of my research. A lot of my research is based on experimental economics, and I use MTurk participants. And so when I was invited to participate in this, it just seems natural to come in and contribute. So I'll start with a story. In 2014, I was traveling back to the U.S. from Lugano in Switzerland, and I had to stop in Milano for transition. So just to get the airplane back to the U.S., I had to move from the airport to hotels. When I got to the airport, I just ran up to a driver, and I'm like, how much will it cost to get from here to the hotel? And I gave him the address, and he said 15 euros. And I was like, cool. I jumped in the cab, and when I got in, I realized, but I'm in Europe, and maybe they don't accept cards, so I should point out that I only have my credit card on me. And so I pointed this out to the driver, and he said, it's not a problem, but the fare will be 20 euros. And I was like, why? Why would the fare go up to 20 euros when it was previously 15 euros? And he said, well, I have to pay taxes. And I'm like, well, you have to pay taxes when it's 15 euros, but apparently not, right? So the idea here is, one transaction is credit, which leaves a paper trail and is therefore making audit for compliance reasons much easier. And the other one is cash, which is not traceable. And so you can see there that just, this kind of story just kind of highlights the importance of having a paper trail. So paper trail makes auditing much easier, and a paper trail also facilitates third-party reporting, which also makes auditing easier. And so all of this just kind of ties into this idea of now we have this gig economy, and we're generating a lot of data. A lot of it is digital, which should facilitate third-party reporting, but apparently it's not happening to the extent that we would like. And the question is, what then are the implications of this for all kinds of things? And so in particular for this paper, the implications for Social Security. So just very briefly, I kind of divided my comments into three parts. Just a quick overview of what was said, and then I'll kind of provide some comments. So the research question, right, is very clear. So what is the impact of the rise in gig economy and the non-compliance associated with this rise on funding, or let's say the solvency of Social Security? In terms of method, we're using SIP to try to get a sense of the number of people who participate, the amount of income that we're talking about, and the amount of revenues that we're losing. And then the conclusion seems to be that we're losing maybe about $7 to $8 billion. And then more needs to be done in terms of policy implication to increase both awareness of the tax obligations and also to provide better access to the data that the tax authority might need in order to enforce these taxes. So in terms of my remarks, I kind of broke up my remarks relative to the comments I just gave. So first, remarks on the research question, remarks on the method, and then remarks on the implications of the research. And on the research question, I would say, based on the draft that I received, that I would probably try to reframe the paper more in line of a future-oriented problem rather than a current problem. And this might actually change given that this base was 2014 data, and now we're in 2020, so the problem might even be obviously worse already. And so why do I say this? So if you look at the 2017 Social Security Administration report, there you will find information on expenditures, you'll find information on revenues, and you'll find information on the total assets of the Social Security Administration. Expenditures, $952 billion, 2017. Non-interest income, $911 billion. Interest income, $85 billion, and the amount of assets that they have set aside, $2.9 trillion. And so then the question becomes, how important is this issue when you're talking about that scale? What is $8 billion in $952 billion worth of expenditures? It's nothing. And so I would say, in terms of the research question, no, it might not seem like a big problem, but certainly at the growth rates that were pointed out to us, this is quickly or potentially could be a big problem in the not too distant future. So just in terms of framing, one might, as an economist, I look at $8 billion and I look at $952 billion and I'm like, well, yeah, maybe not so much. So it's kind of how do you turn a small number into a big number? You could express $8 billion as a function of the gap between the amount of revenues generated and the amount of money spent, and then it looks bigger because it's just $8 billion as a share of something like $40 billion, and then that's like almost 10%, right? So, or even more. So that's kind of one thing that I had in mind. In terms of the method, it's a little bit difficult, or at least was a little bit difficult to assess because we're starting with survey data. So this is just a random sample of the population, and we're trying to estimate the size of a population that is itself a subset of a much bigger population. And so it would be nice if there was more in the paper to explain how that was done. So I can't really comment on that because it wasn't in the paper. But then the other part was clear. So once we have this number, we can then use these back-of-the-envelope calculations based on existing evidence to try to get an estimate of how much revenue are we losing. And there the question becomes, how representative are the summer statistics that you're pulling from the literature for the sample that we're interested in? And so in the paper, you use the term for the Treasury report, statistically valid sample. And it wasn't clear to me what exactly does this mean. So, when the IRS pulls these, let's say the National Research Program Survey, is this it's usually a stratified sample, right? Or at least the sample tends to overestimate or oversamples on high-income individuals because those are the people who are more likely to be evading taxes. And so if that sample itself is not representative of the sample we're interested in, then the back-of-the-envelope calculations can be problematic. In terms of implications, the ideas that you present are, well, we should kind of identify two things. One is people don't know and the other is there is not enough third-party reporting. And so I think this distinction in the paper could be a little bit clearer, because these are two different things, right? One is I don't know that I should pay a use tax on transactions that involve online firms. When I ask my students this, almost universally they will say, what is a use tax? So it's not that they're non-compliant because they're deliberately trying to cheat the system. They're non-compliant because they just don't know. So that's kind of one thing. And then the other is, okay, so I know, but because there's no access to third-party reporting, I can kind of sidestep the system and I won't be caught. And so in the paper, these are two issues, but I think, at least in the draft that I read, this could be divided or at least made more distinct. And then the last set of comments that I have are kind of more conceptual. And so while I'm, the gig economy is a thing, it's not going away. There are lots of issues to be dealt with respect to the rise of the gig economy. I was thinking about this particular question. So why should we care about non-compliance among the gig economy workers? And there are three reasons that I came up with. One is fairness. So everyone who is not participating in the gig economy but earning income is required to participate in the tax system. So it's kind of unfair that one group is being mandated and the other one not. So in terms of fairness, you'd want to do something about the non-compliance. The other would be efficiency. So the idea here is if I am non-compliant, that might affect the way I price my goods. And that then has welfare implications for both myself as well as the individuals that I'm serving. So if you go back to my taxi experience, that driver was willing to charge me 15 euros just to avoid having to pay the tax. And so you could see that I benefited because I'm paying 15 euro rather than 20. And he's benefiting. Presumably he's charging a little bit of markup over what his costs are. And we both benefit from that type of evasion. But that in and of itself will kind of cause a reallocation of resources. And those reallocations might not necessarily be efficient. I mean, they could be, but maybe they're not. So there's this efficiency argument for trying to get at tax evasion. And then the other one is the solvency of Social Security, which is the one that was presented. And here I must admit that I'm a little bit less convinced, at least in the near term. The reason is the current gap is small relative to the overall size of Social Security. So if we don't collect this $8 billion, will Social Security suffer? Or stated alternately, if we were able to collect this $8 billion, would Social Security suddenly be solvent? I think the answer is no, at least not now. And then the other thought I had was Social Security, at least the way I try to think about it sometimes, is forced savings. It's almost as if the government is saying, you're working today, you must save, and when you retire, you will get your money back. We know that's not exactly how it works, but that's kind of the idea. And so if you think of it in those terms, then what you're saying is, currently I'm working in the gig economy, I am not contributing, so therefore I don't get anything when I retire. So now suppose I do contribute. Well, if I do contribute, it means that I'm going to add both to the revenue and the expenditure side of the equation. So the question is, what is the net effect of collecting these $8 billion? Will it really change things, or will it simply just, you have the expenditures go up because you pay out more, but you also have the revenues go up because you collect more. And so on net, it might not have a big effect. And then finally, the money not contributed to Social Security is presumably used either for current consumption or future consumption. Either I consume it today or I save it for tomorrow. I suspect most people consume it today, especially given how low those numbers are. But it also raises the question of which of those two things should we be concerned about from a social welfare standpoint, particularly because I might be concerned that my $800 or my $1,000 that I'm earning today, if I were to put a portion of that into Social Security, there's a very high chance I might not get any of it back. And so from the individual's perspective, is this something that I should be, that I should care about, or should I be like, well, they're consuming it today and they're getting some benefits. They might not get future benefits, but even in the alternative state of the world where they make the contribution, they might not get any benefits. And so, those are kind of my, let's say, thoughts on the paper. But I mean, the problem itself, at least from a future standpoint, I think is super interesting and super important to address. and I hope that the authorities will do something. Thank you.
So much.
So in the interest of time, we're going to ask Professor Bruckner, you've had a lot to go over and a lot of great comments from the panel. Ask you if you have a couple words respond to the panel, and then we'll have closing remarks from Ms. Katie Sliz and Liam Williams.
Nope, I took copious notes. I'm very grateful. Comments from people taking the time to read my work. Again, trying to formulate an argument as to why this matters is hard. I mean, I think fundamentally platforms are exploiting the fact that these returns are not provided, and that if they did have to provide those returns, it adds to their churn. So practically speaking, that's why they don't do it. And you know, a big argument is that there's potentially audit and penalty exposure for these taxpayers, and because they're not doing it. And we know from the latest press reports on who's getting audited, it's low-wage workers. And that's definitely one of the big reasons to care about this, but it's a hard argument to make. You were absolutely right going, why do we care? These are low-dollar numbers. And, you know, they do get bigger when you try to make them more akin to what a JCT estimate would be.
Yeah, like at the 10-year window.
Yeah, they become bigger faster over a 10-year window. But thank you so much. I am very, very grateful. Thank you so much for having me. I'm sorry I spoke too long. I get really excited. We can talk about this afterwards. I have so much more to say.
And we can indeed talk about this afterwards. If anyone who's here would like to join us at the Inkwell on the square for a reception afterwards, we're going to have some of our journal members who will help escort you over there. Anyone who can attend, we've got some grazing and some